Hey there. Get ready to decode the markets, folks, because today we're diving deep into the world of technical analysis.
Sounds exciting.
You bet it is. You've been digging into some serious trading knowledge lately, and you sent over this YouTube video, the only technical analysis video you'll ever need.
Catchy title.
Right. Hopefully it lives up to the hype.
Well, with a title that bold, it's got to be good, right? But yeah, it's a solid starting point for sure to wrap your head around the core concepts.
Okay, so the video jumps right into candlestick charts, which I have to admit always looked a bit like, hieroglyphics to me at first.
Yeah, they do have that kind of unique visual language, but once you get the hang of what each part of the candle means, they become super insightful.
Right, right. It's not just like, oh, green candle, price went up. It's about the wicks, the body.
Exactly.
Did the buyers or sellers have the upper hand, during that time frame? It's like a mini battle report for each trading period.
That's a great way to put it. A mini battle report. And, the video points out those 38.2% candles, which are fascinating, where sellers pushed the price down, but then buyers swooped in and drove it right back up.
Yeah, those are interesting. It almost felt like those candles were hinting at a possible trend reversal in the making. Is it really that simple though? Like you see one of those candles and boom, reversal. Or is it, more nuanced than that?
It's unfortunately rarely that simple.
Yeah.
One candle alone doesn't tell the whole story. It'd be like seeing one frame of a movie.
Yeah.
You get a glimpse of the action, but you don't know the whole plot.
Right.
So those candles are definitely something to pay attention to, but you got to consider them in the context of everything else that's going on.
So that's where we zoom out and start talking about identifying the overall trend, right? Uptrends, downtrends, support and resistance levels.
Exactly. Think of support and resistance levels like those psychological battlegrounds on a chart. They're like magnets that can either attract or repel the price. And what's fascinating is how a resistance level, once it's decisively broken, can flip and actually become a potential support level.
Oh, interesting. Like a broken barrier that suddenly becomes this line of defense.
Yes, exactly.
I remember the video gave that example using past resistance levels as potential buy zones in an uptrend.
Yeah.
And it made me realize how important it is to look at the historical price action, not just what's happening in the market, right this second.
Absolutely. It's like that saying, history doesn't repeat itself, but it often rhymes.
Ooh, I like that.
Past price action gives us valuable clues about where those key support and resistance levels might pop up in the future.
It's like having a secret map with potential treasure spots marked, right?
Yeah.
But even with a map, you need the right tools to navigate. And that's where I think the video's discussion of indicators comes in. It felt like we were adding special lenses to our chart reading glasses.
Indicators are like having an extra set of senses. They help us see things in the price data that might not be obvious just from the raw price chart.
Right, right. And one that really stood out to me was the average true range, or ATR. He made a great point about how crucial it is, especially in those volatile markets where prices are swinging all over the place.
The ATR is all about respecting the market's natural volatility. Make sure your trades have room to breathe so you're not getting stopped out on every little price fluctuation.
Because those little wiggles can be so misleading, right?
Absolutely.
It's easy to get shaken out of a trade too early if you're not careful. Then the video moves on to moving averages, which always seemed kind of intimidating to me. But the way he explained how they smooth out the price data, suddenly they seem a lot less scary.
Moving averages are basically like finding the pulse of the market. They cut through the noise of those daily price fluctuations to reveal that underlying trend.
And he focuses on the 20, 50, and 200-day moving averages. Are those the ones that you personally use the most in your own trading? Or do you have other favorites?
Those are definitely popular for a reason. They each give you a different perspective on the trend. But for me, the specific ones I use, it really depends on the time frame I'm trading and the asset I'm looking at.
Makes sense. Each trader has their own style, right?
Absolutely.
And speaking of different tools, he also talks about using moving averages to set trailing stops, which, I don't know, it seems like a cool way to potentially lock in more profits, especially during a strong trend. Have you used that strategy before?
Oh yeah, trailing stops can be powerful for that very reason. They let your profits run as long as the trend is in your favor, but then they automatically lock in those gains if the price starts to reverse. It's all about managing your risk, but also maximizing that profit potential.
It's like having a safety net that kind of adjusts as the trend progresses.
So smart. Okay, so then he gets into the Relative Strength Index, or RSI. I've always found the RSI to be a bit of a wild card, to be honest. Is it reliable on its own? Or do you always look for, like, confirmation from other indicators?
The RSI can definitely be helpful. It helps spot those potential overbought or oversold conditions, but like any single indicator, it's crucial to use it in context. You got to look at the bigger picture, the market overall, other technical signals. Don't rely on the RSI alone. You might miss some opportunities.
It's all about connecting the dots, right? Looking for those confluences. And speaking of connecting the dots, that's where we get into the exciting part, entry patterns. It's like we've laid the foundation with candlesticks, trends, and indicators, and now it's time to talk about how to actually use all this knowledge to spot those trading opportunities.
Exactly. It's like putting all the pieces of the puzzle together, right? We're moving from the what of technical analysis to the how. And that's where things get really interesting for traders who want to put this knowledge into action. Absolutely. And he starts with candlestick patterns, which makes sense, starting with the basics. One that he highlights is the engulfing candle, a big green candle that swallows a smaller red one. Suggests strong bullish momentum. Have you had much success trading engulfing candles yourself?
Engulfing candles can be powerful signals for sure, especially when they show up near key support levels or within a larger uptrend. But like any single candlestick pattern, context is key. Is it happening at a key support or resistance level? Is the overall trend confirming what the candle is telling you?
So even with a seemingly bullish candle like that, you're still looking for that confirmation from the rest of the chart.
Exactly. A single candlestick pattern can be a great starting point, but you got to validate it with other signals before you hit that buy button. Think of it like double checking your work.
It's like checking multiple sources before making a big decision. You don't want to rely on just one piece of information, no matter how tempting it might seem. And speaking of validating signals, he also digs into some really specific rules for identifying double bottoms and double tops.
And this is where discipline comes in. It's so easy to get caught up in the excitement of maybe spotting a double bottom or top. But his rules help to remove some of that emotional bias.
One thing that stood out to me was his emphasis on drawing what he called a termination zone to confirm the pattern before entering a trade. Have you heard of that?
Oh yeah, the termination zone. I love that he included that. It adds that layer of objectivity to your analysis. By defining that zone, you're basically saying, okay, the price needs to break above this level or below it for me to consider this pattern valid. Helps you avoid those false breakouts that can be so costly.
It's like drawing a line in the sand, like for yourself. It helps you stick to your plan and not make those emotional decisions. And speaking of practical tips, I love how he walks through, step by step, how he would actually enter a trade based on a double bottom. He even showed where he'd place his stop loss and profit target. Very cool.
Having that real-world example is so helpful, especially for newer traders. It takes the theory and turns it into action, and it highlights how crucial it is to have a plan for every trade before you even enter it.
It's like having a roadmap for your trade.
Exactly. You know where you're entering, where you're exiting if things go wrong, and where you're aiming to exit if everything goes according to plan.
Love it. Okay, so that brings us to, I think, another really exciting topic. Breakout patterns. Those moments when the price just, like, surges out of a period of consolidation.
Breakouts are exciting.
Right?
They're like a coiled spring that's finally released. And what's key is that they often signal a potential change in momentum, which can be big.
So spotting one of those could be a heads up that a big move is brewing.
It's possible, for sure. But, and I know I sound like a broken record here, but it's all about context. Just because you see a flag pattern doesn't automatically mean a huge price move is a guarantee. You need to consider the overall trend, the strength of that preceding move, and any potential support or resistance nearby.
It's like those engulfing candles, right? One pattern alone isn't always enough. You need other things to back it up.
Yeah, like being a detective, You got to gather your clues.
I like that.
You're looking for that confirming evidence before you make your move.
And some of the most compelling clues, I think, come from those moments when the market, like, breaks out of a pattern, right? It's like the calm before the storm.
Oh, yeah.
You can feel the tension building and then, boom, breakout. Could signal a big shift in sentiment, maybe some huge price moves.
Yeah, and one of the things I appreciate about this video is he doesn't just point out the patterns. He talks about the psychology behind them too, like those flag patterns, for example.
Right.
He explains how they often represent a pause, like a breather, in a strong trend.
Okay.
Where traders are catching their breath before they jump back in and push the price even higher or lower, in the case of a bearish flag, of course.
It's like everyone's lining up on one side of the tug-of-war rope, taking a break, and then they're ready to pull even harder.
Yeah.
Makes sense. And speaking of psychology, he also gets into ascending and descending wedges,
Right.
which I always find those fascinating, how those patterns can sometimes hint at a potential reversal. Like the market saying, uh-oh, things are changing.
Yeah, it's like warning signals almost.
Mm-hmm.
The initial move might have been strong, but now the momentum is maybe fading. Reversal could be coming. And what I find really helpful is he gives those like specific things to look for
Right.
to identify these patterns. Like, look at the angle of the wedge, he says, and the volume patterns.
It's those details that can make all the difference, right? He doesn't just say, look for a wedge. He's like, look for this specific kind of wedge with these characteristics.
Those specific rules, they help traders avoid getting tricked by those false breakouts or, entering trades just based on what they want to happen, not what the chart's actually saying.
Hoping and wishing.
Yeah. It's about taking your emotions out of it as much as you can, which, let's be real, that's tough.
Oh, yeah.
Trading can be such an emotional roller coaster.
It's true. It's easy to let your hopes and fears get in the way.
Trading psychology, that's a whole other deep dive we can do, honestly.
Right.
But it's something that every trader, especially new traders, really needs to be aware of. The more you can remove those emotions and just approach it logically, objectively, the better your decisions are going to be.
Which is, like I said, easier said than done. But
Definitely.
that's where having a solid trading plan becomes so important, I think.
100%. And that plan should include, how you're going to find those opportunities, how you manage risk, how you handle winning trades, but also losing trades, which are going to happen. It's like a roadmap for your trading.
Yeah.
Keeps you on track.
Love that analogy. A roadmap. So this YouTube video, I think it does a great job of laying out the fundamentals of technical analysis. But as he mentions, it's just one perspective. What are some of the biggest lessons you've learned over the years, maybe things that weren't covered in the video? What advice would you give to someone who's just, dipping their toes into this world of technical analysis?
Ooh, that's a great question. I think one of the most important things is to remember that technical analysis, it's not just a science, it's an art too. Yeah. There's no magic formula. There's no one indicator that's going to guarantee you're going to be successful. It's about understanding those tools.
Yeah.
Yes, learning how to read the charts, but also honestly trusting your gut, developing your intuition.
It's like learning a new language, right?
Yes.
You can memorize all the grammar rules, but until you immerse yourself,
exactly,
you're not going to be fluent.
And just like with language learning, consistency is key. Don't expect to watch one video, read one book, and become a master trader overnight. It takes time, it takes dedication, and, you're going to make mistakes. You have to be willing to learn from them.
And speaking of mistakes, let's talk about risk management, because that's something that the video kind of touches on, but doesn't go too deep into, and it's so important.
It's crucial. Honestly, I'd say it's even more important than being able to pick winning trades.
Yeah.
You can be the best chart reader out there, but if you're not managing your risk, you could still lose everything. One bad trade, one unexpected market event, it can wipe you out.
It's like being an amazing driver but having no brakes.
Exactly. You might be skilled, but eventually you're going to crash.
So how do you incorporate risk management into your own trading? What are some practical tips that our listeners can, use?
So one of the most effective tools, and we talked about this a little bit earlier, is stop loss orders. Basically, it's like a safety net. You're telling your broker, if the price drops below this level, sell my position automatically.
Okay, so it's a way to limit your losses on a trade. Got it.
Exactly. And the key is to place them at a level that makes sense for you, for your risk tolerance.
So it's not just picking a random number. It's really looking at the chart, understanding the market conditions, and saying, okay, if it breaks below this, my initial analysis might have been wrong.
Exactly. You're protecting yourself from those unexpected moves. Yeah. Because in trading, it's not about winning every single trade. It's about staying in the game long enough to let your winners, outweigh those losses.
It's about playing the long game, not trying to get rich quick.
100%. It's a marathon.
So we need to pace ourselves. We need a plan. And speaking of plans, this deep dive has been awesome. We've covered so much: candlesticks, trends, indicators, entry patterns, risk management. But, our listeners are probably thinking, okay, that's great, but how do I actually put this into practice?
It's one thing to understand the theory, but putting it all together in the real world, that's where the real learning happens. And one of the best ways to do that, in my opinion, is with a demo trading account.
Oh, like a simulator.
Exactly. You can test out different strategies, you can experiment, you can see what works for you without risking any actual money.
So it's like training wheels for traders.
Exactly. You can make mistakes, you can learn from those mistakes,
Yeah.
all without the stress of, oh no, I'm losing my shirt.
Because trading with real money, especially when you're first starting out,
Intimidating.
it's intimidating. All those emotions we were talking about, fear, greed, they're amplified when it's your own money on the line.
For sure. That's why demo account is so great. It's like pressure's off, explore, try things out, see what happens.
And even for experienced traders, right? I mean, I would imagine even seasoned pros could benefit from like testing out new strategies in a demo account first.
Absolutely. Like a professional athlete practicing their drills.
Exactly.
You got to stay sharp. You got to keep honing those skills. And the best part is, demo accounts are so easy to get these days.
Oh, really?
Most brokers offer them for free, so yeah, no reason not to take advantage of that.
Yeah, it's like a flight simulator for trading. You can practice, you can, make your mistakes without the real world consequences.
Exactly. And just like flying, there are so many different ways to approach trading, right?
Right.
What works for one person might not work for another. And that's where that experimentation comes in, I think. Use that demo account, try different indicators, different time frames, different styles, and see what clicks for you, what feels good, but also what gets you those consistent results.
Because at the end of the day, consistency is what it's all about, right?
100%. It's not about being right every single time, which is impossible.
Right.
It's about making those smart decisions over the long haul, managing your risk.
So as we kind of wrap up this deep dive here, what's the one thing you hope our listener really takes away from all of this? What's that one piece of advice that you wish someone had told you maybe when you were starting out?
Ooh, that's a tough one. Because there's so much, right? There's so much to learn. But if I had to pick just one thing, I would say don't be afraid to be wrong.
Interesting.
Because you're going to be wrong. Trading is a journey, and you're going to make mistakes. But the key is to not see those mistakes as failures,
Oh, I like that.
but as learning opportunities.
Yeah, that's a good mindset shift. It's easy to get caught up in, like you said, being right, winning every trade.
Totally.
But it's how we learn from those bumps in the road that really
Yeah,
matters.
exactly. So embrace the learning, be patient, and never stop learning and asking questions. The more you know, the more confident you'll become.
Well said. So to our listener out there, keep exploring, keep practicing, and remember, never risk more than you can afford to lose. Happy trading.